Welcome back to Market Call. Mike Archibald of AGF Investments has been taking your calls on Canadian equities, and now it's time for his top picks. So first up, Mike, we have Dollarama. Why did you choose this name?
Yeah, so I think Dollarama is a great short, medium, and long-term investment. The company is very well managed, very well capitalized, great balance sheet, and has good long-term predictable growth. So clearly, some of the macro environment is helping them out. You have high inflation, and you have a consumer that feels a little bit stressed, and that's moving customers down into dollar stores. And you've seen that in some of their financial metrics. So the foot traffic at their facilities is continuing to move up. The basket sizes that customers are buying is continuing to move higher. And by extension, same-store sales growth has been quite robust. So, the financials are looking quite good here. The company has recently introduced new $5 price point items, so that's driving incremental demand for some higher priced products into their store. And I see no reason why they can't continue to introduce further price point items, in the coming years. So, it's a very well-managed business. They have great purchasing power and scale, just given the size of their overall network. So they're able to pass on any cost inflation that they would have with their inventory to end customers. With respect to the financials, revenue is growing somewhere between 7 and 10% historically over time. I think you can see earnings growth of somewhere in the neighborhood of around 15% annualized for the next 3 years, and they continue to have as I said, a lot of free cash flow to continue to grow their store count. One other area of growth, I think, for the business that's not talked a lot about is Dollarcity. So this is the South American dollar stores, Colombia, Peru, El Salvador, areas that have about 100 million people in terms of population. They own the majority of that business. It's growing significantly faster than the Canadian arm of their business. So I think it's a good offset to the more mature Canadian market over time. The stock's been hitting 52-week highs as recently as yesterday. It continues to be a name that I think investors are going to flock to, just given the predictability and quality of the company.
Yeah, and just how I was thinking as consumers are feeling more and more stretched, that's right, it is a great name right now. Okay, let's get to your next one, Tricon Residential. What was behind this choice?
Yeah, so Tricon is a company that operates primarily in the U.S. marketplace. They buy single-family residences in the Sun Belt region and then rent those homes out. So good areas. They operate typically in areas like Texas and Florida and other Sun Belt regions. Population demand is growing, outpacing growth in the broader United States in the markets that they're in. So there's good demand for their properties. Great management team. The Berman family's done a great job of growing this business over time. They know the market very well. They have a very well capitalized balance sheet, and they have good institutional partners to continue to grow this business over time. They currently own and operate 31,000 properties in the U.S. Their goal is to grow that up to 50,000 by the end of 2024. So think about a couple thousand properties per quarter, which is what they've historically been able to do. I think with the balance sheet and the partners that they have, if real estate continues to soften in the U.S., it'll give them a good opportunity to continue to buy large packages of homes, which is what they've done in the past. So it's a very fragmented market. I think they're excellent operators. They buy well, and then they refurbish the properties and rent them out well. So they've seen rent growth in the last year of about 8%. 98% of their properties are currently occupied, and turnover of their units is significantly lower relative to other comparables in the U.S. marketplace. So I think there's a long runway for growth. I think the team has done a good job over time. We've owned the stock in the past. It got as high as $21, I think, earlier this year, and has sold off just on concerns around economic growth, and whether or not they'd be able to continue to grow at the same degree as they have in the past. We aren't seeing any of that in the numbers. So we've been buying the stock recently around $13. I think it's going to turn out to be a great investment.
Okay, and last but not least, your last top pick, CAE. Why did you choose this one?
Yeah, so CAE is a name I've talked about a couple of times on the show. They provide simulation training for pilots and crews in both civil aviation and in defense aviation. Really strong business, great high barriers to entry. They're the market leader in terms of what they do. They have approximately 30% market share of the aviation training market. Really good global footprint, really high quality customers. So they deal with most of the major airlines in the world and many developed market governments. And they have a really good technology platform. Certainly there's been some challenges, as all will know, with respect to airlines. 2020 and COVID, and then certainly what we've seen lately with respect to cancellation of flights just because they don't have the proper number of pilots or air crews. All of those are actually good for the demand of CAE, and so I think as we get to a more normalized world, we've certainly seen leisure travel pick up. I think in the next couple of years you'll see business travel pick up, and there will be further demand for more pilots and crews, and I think those are all good things for CAE. So obviously the earnings of the company came in fairly significantly in 2020 and 2021, so we're starting from a much lower base here, but consensus forecast is looking for 25 to 30% earnings growth in each of the next 3 years. The company's done a great job of preserving the balance sheet and keeping margins relatively stable, in a troubled time, and they don't have a lot of leverage on the balance sheet either. It's been in line with history. So, I continue to think that this is going to be a great investment over time. We were buying the stock recently around $30. I think for patient investors, this is an area of the market that still exhibits some growth. And like I said, with a few other companies I've talked about earlier, good high quality compounding company. And when these things come on sale, I think you have to buy them. So really like the business here. I think you'll be well rewarded over a 2-year period.